Okay, hello everyone. Capital structure is one important concept that we often discuss in finance. When we talk about companies, they should have a proper plan on how to structure their capital or what should be the structure of the capital. We can see what is capital structure, what does it mean, what are the important components and all. Capital structure refers to the mix of debt and equity of a company. Okay, every business or most of the business, we can just generalize, most of the business will have a proper ratio on how far of the business is funded with owners fund. Please remember, when we talk about a business, we often talk about a company format where we will have more than one investors. Okay, company will have more than one investors. So we should have a proper idea on what part of the company's capital requirement, is funded with the amount collected from investors, and what part should be lended, in what part should be borrowed from other sources like bank. Taking money from investors has its own risk and its own benefits. Okay, taking money from borrowing options have its own risk and its own benefits. So an intelligent financial manager will help the company to make a proper decision on what should be the ratio of the mix of debt and equity, the borrowed fund and owner's fund. It can be, okay, just think it is debt, it is equity. The company can take 0 is to 100 percentage, that is no debt, fully equity fund. They can take 100 is to 0, that is no equity, only debted fund. No problem, anyone can choose. Okay, or they can go for any ratio between 1 is to 99 to 99 is to 1. Yes, they can choose anything, any number, but it depends on the many factors that affect the business individually. We can see everything. So you should understand the capital structure is this mix, the ratio which shows what part of the capital requirement of the business is funded with the owner's fund and what part is funded with the help of debt fund. Just see, this is the question, what part should go for what? Okay, what should we make the major funding with the help of debt fund, or should we go for equity, or should we go for debt alone, or should we go for equity alone? These questions are answered in the form of capital structure of the business. There are key importance why we should think about capital structure. Yes, capital structure will ensures the cost of capital. Remember, cost of capital means the amount spent to acquire the capital. Since we are not going such deep, we needn't discuss like that, but you should understand one thing, there is a cost. If you are raising some money, you just think you are raising money from equity investors, or if you are raising money by borrowing, there is some cost related to, isn't it? We need to pay interest, we need to pay shares, share on the profit to the investors. Anyhow, from which source we are taking, there is some cost involved with it. So it is very important that to make an proper plan on capital structure, or else we will pay a lot of amount as our cost of capital. Then we should consider the risk and return of the business. Okay, from each options, like if you are taking money from investors, as I told earlier, there is a chance of making a return from it, but there is a chance of having a risk. You should consider that. If you are taking borrowed fund, there also, with that fund you can make some return, of course, but at the same time risk is also there. So we should consider both of the risk and return, and thus make a proper decision. Also, we should be able to make financial flexibility there. If our capital structure is making us jam between two decisions, our company will not move forward. There should be flexibility. If you think you can do everything with equity, and after that if you feel you are trapped there, we can't move forward. So always there should be a room for what? Contingency. There should be a room for making changes in our capital structure. There is agency cost. What is agency cost? Agency cost is another concept, but not related to finance. Don't take it as like that. Agency cost says that when we are taking more equity, okay, this thing we are taking more equity fund, then the managers of the business will have to work like a agent of the home, agent of the investors. This may have some problems. This may make some problems, some kind of ego clash, some kinds of problem, conflict of interest between the managers and investors. So when we make capital structure decision, we should consider that also. The interest of both shareholders and managers should be equally considered. Moreover, capital structure gives a signal. It is very important. Finance theory suggests that a company should have more debt than equity if it want to pay more benefit to equity shareholders. It is a financial statement that is well proved with or real life factors. So it is a signal. If a company is having more debt than its equity holders, then it is a signal that it is planning to give more value to the equity shareholders, isn't it? So it acts as the capital structure of a business acts as a signal to the upcoming prospective investors. Also, there are tax implications. Everyone know very well, if we are planning to make tax savings, we should go for debt fund, because the interest that you pay for debt fund is something for which you will get tax exemptions. But when you are going to take fund from investors, it has some tax attractions. So you should have a proper plan. You should have a proper idea about tax implications before making capital structure decisions. Moreover, there is a limit on how far we can take debt, because if we are unable to repay the debt, it will affect one of the most invaluable intangible asset of the business. It is credit worthiness. If the business is believable for banks, they will give you more loans. But if we are not able to repay on time, we will lose our credit worthiness, and it has a very bad impact on our business. Control is another reason why capital structure decision becomes important, because think you are giving more importance to equity shareholders. It means what? More investors will come to a business, and the decision making power will be divided to more people. This will cause your decision making power delegated to others. So you would have to rely on the decision made by other people to conclude something. So if you are someone who don't want to lose the decision making power, you should not think much about collecting fund from equity shareholders. It is another important factor. We are talking about financial flexibility. The valuation of a company are often made by investors. There are credit rating agencies that value a company's financial performance. They also consider the capital structure as an important factor to value the company. Now, we have already discussed the main factors, but once again we are going to see the main factors, the factors that determine the capital structure. We should have a common idea. We should have a proper thought about what all factors should be considered before making a capital structuring decision. That means before making a decision on what part of the capital should be funded with the help of debt and what part of the capital should be funded with the help of equity. The very first factor is, of course, risk tolerance level of the business. If the business can take enough risk, it can go for the risky investments like equity shareholders. But remember, if the business is something that don't have proper flow of income, it is very risky to take bank loans. Why? If you are taking bank loans, I mean debt fund, it will not be able to repay on time. So there is a risk factor. So the business, before making a capital structure decision, should have an idea on what is the risk taking capacity of the business. That is, what is the risk tolerance level of the Similarly, what is the growth prospect of the business? If the business is what? If the people who is handling the business have an idea to bring a growth to the business, if they see a growth perspective, what they can do? They can they can invest more on the business. But if they are someone who is not seeing growth prospect in the near future, there is no meaning in investing more in the business. Okay, we can just keep the investment as it is, and we needn't take much risk there. But if you can see some prospect, just think you have started a electric car selling company. Okay, recently you can see the trend of electric car selling is going up, so you see there is a prospect. Now you can easily uh, invest in the business and you can take the risk. Okay, but if you don't see the prospect, if you don't feel like your business is going well right now, your investment should have less risks, so the capital structure should be adjusted accordingly. Also, if the business has more asset, okay, just think the business have asset of more worthy things, then what they can do, they can take debt easily. Why? They can pledge their assets and get easy loans. But if the business don't have assets and if they are focusing more on unpledged loans or unpledged debts, what will it happen? The risk is very high. It will create very bad impact on the credit worthiness. So the capital structure of the business is also related on the asset base of the company. Now, the tax rate, in other words, the tax implication. Whenever we are making a capital structure decision, we should see whether having more owners fund or more debt fund will give tax savings to the business. But if it is not the primary concern, we can just forget it. But if tax saving is one of the main concern here, we should also consider whether choosing between owners fund and debt fund create tax implication in the business. Also, we have financial flexibility. If our business is not feeling flexible means, please understand, we should be able to move between owners fund and equity fund according to the changing market. So while deciding the capital structure, we should have a proper idea on financial flexibility of the business. Now, the market conditions. Sometimes the market will look bullish. I hope you must have heard of the word. Sometimes it will go bearish. If the market is bullish means more investors are coming up, they are more interested to buy shares or something, the market somehow is going up. But if the market remains bearish, sometimes they will act opposite, isn't it? They won't show interest. So if the financial market has generally performing well, if the investors are more confident about the financial market and its performance, it is very good time to take owners fund because they are more active. But if it is going wrong, if the financial market is going downward, and then if you are introducing your financial product to the financial market, what will happen? Less people will show interest and you will not get fund as you expected. So the market condition also judges what should be our capital structure. Agency cost we have talked before. Industry standards. Okay, every industry, okay, that is very important things to understand. Every industry will have their own standard. The industry will perform how? According to a common thing. Just think you are going to start a hotel, okay. Then the hotel industry will have a proper standard on the capital structure, like just think 70-30. This would have been fixed as a standard as a successful capital structure. That means 70% owners fund, 30% debt fund. So before taking a decision, you should also have an research on what is the industry standard for capital structure, whatever industry you are going to do business. Also, there are legal and regulatory constraints. Basically, for taking owners fund, you can collect money from stock market, you can collect money from financial market. Yes, it is right. But the legal bodies like SEBI will put a cap on how far amount you can collect from owners fund. You won't be able to collect as much as fund you needed. They will fix a limit on how far you can collect funds. So There are legal constraints on how preparing capital structure. So we should consider that also. We shouldn't plan without considering the limit that law sets. Finally, the management which have enough experience will have their own preferences, or even if they are creative enough, they will have their own preference on how far capital should be owners fund and how far it should be debt fund. So these factors are very important even from a company side and also for your exams. So make sure you know what is capital structure, what is the importance of capital structure, and what are the factors that determine the capital structure planning. Hope the concept was clear for you. Thank you all.